To begin today's discussion, I'd like to make a couple of general comments. First, there's way too much information to try and memorize. It's more important to know where to find information, publications, training documents, your fellow tax counselors. Don't be afraid to ask questions and take advantage of the knowledge that your fellow tax counselors have gained through experience. You'll be able to use every resource while preparing for and taking the certification tests and in any activities while supporting the taxpayers we support during tax season. It isn't expected that you will totally remember everything you hear today. You've already heard that an essential document, and one required to be available at each tax site, is the Volunteer Resource Guide, publication 4012. On the Chromebooks provided by Tax-Aide, there's a tab for Tax-Aide links, and the drop-down menu is an option for tax prep. Selecting that option provides a link to the NTTC Modified Pub 4012. One of the first things I do upon arrival at the Tax-Aide site each day, every day, is to open up a copy of the NTTC 4012, which contains the latest updates. You'll hear a lot in the upcoming presentations on scope for Tax-Aide, what's in, what's out. You can find the scope manual by using the link in the 4012 table of contents. Okay. Just a little story before starting on this morning's main topic. Within just a few days of starting as a brand new client facilitator, I overheard a conversation between a taxpayer and one of our quality reviewers who was very experienced and had been volunteering in that role for quite a few years. The taxpayer was asking why he had to pay taxes and kept repeating his question over and over. I was thinking, he's not happy because he owes the government money on his tax return. But after a while, I realized he wasn't complaining about the amount he owed or didn't owe. He was questioning and complaining about why anyone had to pay taxes in the first place. The quality reviewer told him several times, trying different approaches, that essentially we owe taxes because it's the law. And he said, well, why does the law apply to me? To which she replied, well, the laws apply to all U.S. citizens, but there's a way that you wouldn't owe anything and would not need to file a return. When he asked how, she said, just don't receive any income. Which leads us to this morning's topic of income. Income is money. It's generally received for work products or through investments. Critical component necessary to accurately complete a taxpayer's return is distinguishing between taxable and non-taxable income and knowing where to report the different types of income on Form 1040. All income is taxable, unless specifically excluded by law. You find $100 in the street, that's actually income, because there aren't any exclusions in the tax law for found money. Through the course of your tax counselor education and the experience you'll gain, you'll become more exposed to what is and is not taxable. We'll start out by taking an overall look at different types of income that are divided into taxable and non-taxable categories. Remember, all income is taxable unless it's excluded by law. On this slide, you can see examples of taxable income as identified in Pub 4012 Tab D. Today, we'll be covering several of the more common taxable income categories, including wages, alimony, dividends, interest, refunds of state taxes, and I'll include tips as well. Other examples of taxable income that our taxpayers commonly receive will be covered in future discussions. This is all a learning experience. It never stops. As an example, just last year I worked with several taxpayers who had tax forms indicating they received interest from businesses providing funeral services. Turns out that funeral services or businesses are required to pay interest on money clients use to pay for prepay for funeral services. That interest is taxable to the taxpayer. Here's a list of non-taxable income types. Although alimony may or may not be taxable, depending upon the divorce and or legal separation decree date, child support is non-taxable. If a taxpayer was injured and filed a claim through the courts for restitution, assuming they won the claim, they would be normally awarded a compensatory payment, which is intended to place the injured party in the same position from a money perspective as if the injury had never occurred. In addition, they could have received a punitive damage award, which is intended to punish the at-fault party. Civil damages paid out as a result of a court action that are compensatory for personal injury and so forth are not taxable. But punitive awards, those are the really big ones we hear about, $150 million, $1 billion, those are taxable. This is a good example how two subcategories of income could be either taxable or non-taxable. Death benefits, life insurance payments upon the death of anyone, are not taxable. Federal income tax refunds aren't taxable at the federal level. It's just common sense. Taxpayers already paid tax once. Taxing it again just be double taxing the taxpayer. A cash gift or equivalent in stocks, land, new car is not taxable. The taxpayer received the gift no matter the amount. The giver is allowed to gift up to $16,000 per person in 2022 without having to take any tax-related action. However, any amount over $16,000 gifted to a single person must be reported on IRS Form 709, which counts against the giver's lifetime maximum gift exclusion, which is $12.06 million per person at the present time. So feel free to give away $12.06 million and not pay any tax on it. But give away one more dollar and you'll be taxed on it, or at least it'll be treated as taxable. Inheritances are also non-taxable, but a distribution from an inherited pension or annuity is subject to the same tax as the original owner would have had to pay. Rent is not taxable. But remember that any rentals of more than 14 days are out of scope for Tax-Aide returns. Although reporting of Social Security income will be covered in another presentation, 15%, remember, 15% of every taxpayer's Social Security income is non-taxable, no matter how much the other income received. Depending on other income, the amount of a taxpayer's Social Security income that's taxed ranges from 0 to 85%. I'm talking about this because the situation I can pretty much guarantee you'll experience is a taxpayer couple who are upset because their taxes have gone up for seemingly no reason from one year to the next. For years, they may have been receiving just Social Security income, some minor interest from CDs or savings and checking accounts, resulting in little to no taxable income. And then one year they owe a lot of tax and believe their return was not calculated properly. You must have done something wrong. How many times have I heard that? In this situation, they're most likely unaware that when they start taking required minimum distributions, it's now at 72 or the April after you turn 72, from traditional IRAs, 401ks, and so forth, it can have a big impact on how much larger a percentage of their Social Security payments are taxable. They believe that having taxes withheld covered their tax distributions, but they didn't know or understand what effect the additional income from the retirement plan would have on the Social Security tax. Don't worry, the tax software will figure out how much of the taxpayer's Social Security will be taxable. Just be aware of the impact other income may have on the percentage of Social Security income that is taxable. By the way, the best way that I've found to explain to the taxpayer what happened is to show them on their 1040, right on the front page, how much of their Social Security income they were taxed on. If you have the prior return, discuss the difference between the 2 years. Generally, once taxpayers receive an explanation of why such and such occurred and how extra income can impact taxable Social Security benefits, they're a lot more understandable and reasonable. This year I worked with quite a few taxpayers who paid no Social Security tax in 2020, but were taxed on a high percentage of their Social Security account in 2021. So, bottom line, income that's taxable must be reported in taxpayer's return and is subject to tax. Income that's non-taxable may have to be shown on a taxpayer's return, but it's exempt from tax. As an example, tax-exempt municipal bond income, interest income, I should say. Some non-taxable income, such as gifts, are excludable and not reported on the return at all. Earned versus unearned income was covered in a prior presentation by Vern on Tuesday. As we'll be looking at how to report income, I thought a little refresher might help. On this slide, you can see examples of earned and non-earned income. A more comprehensive list can be found on the first page of tab I in the 4012. Earned income includes all taxable income. Wages the taxpayer received from working for someone else, the taxpayer through self-employment, or from a business or farm owned by the taxpayer. For some people, almost all or all of their yearly income is earned income. Unearned income involves money you make without having to work or provide a service. When it comes to filing taxes, the difference between earned and unearned income might seem like a minor one because it's all income. However, the IRS doesn't think so. And if you mix up earned and unearned income on tax returns or forget income sources of either type, it could cause problems for taxpayers. You don't necessarily have to memorize every type of income and which category falls into. Just remember, if a taxpayer sold goods or provided labor, the money they made is earned income. If they have investment income or other sources of income that don't involve any work or services, that money is unearned income. It's important to know the difference between the two, because qualifying for credits such as the earned income credit, which we'll learn about later, depend on levels of earned and unearned income. In the case of the EIC, investment income which is unearned must be less than $10,000 to qualify. I had 2 taxpayers last year who were positive that they should have qualified based on the earned income, the level of the earned income they had. And they were right. Unfortunately, both had more than $10,000 in unearned income, which meant they didn't qualify. Another example, by the way, are contributions to an IRA. Those contributions must be from earned income. We'll cover tips in more detail in just a bit, but I did want to mention the tips, if received supporting tax aid, are not income because you aren't allowed to accept tips. And we'll move on. We've now seen an overview of the types of income that taxpayers may receive. During the intake interview process and before starting the entry of a tax return in TaxSlayer, all of the taxpayer's income should have been identified and noted in the intake interview and quality review sheet in Part 3, which is shown on this slide. This is a screen in TaxSlayer that supports the record of income and federal returns. We'll be seeing this in just a few minutes online. For presentation purposes, I truncated the list. Please note the loss from business is out of scope. We're now going to shift from a more general discussion to focus on specific types of taxable income and how to capture this income in the TaxSlayer software application. These income types are presented along with exercises in the NTCC self-study guide, which you should be looking at, right, and working with right now. The first types of taxable income we'll discuss are wages and tips, which are reported in the W-2 form. You can find information on income in publication 4012 tab D and lesson 8 in publication 4491, which is the training guide. So when a taxpayer presents any income documents, W-2s, 1099-Rs, 1099-INTs, 1099-DIVs, or 1099-SAs, Social Security statements, then we must input any and all information from those documents into TaxSlayer software to create an exact copy of what's on the document. So the bottom line is, if you see it, key it. If it's on the document, key it into TaxSlayer. Here's an example of a W-2. Notice the boxes. Box 1, wages, tips, and other compensation. Box 2, federal income tax withheld. Box 3, Social Security wages, and so forth. All we'll need to do is place the information from the W-2 form into the matching box in TaxSlayer. So box 1 of the form goes into box 1 in TaxSlayer, box 2 goes into box 2, and so on. On this W-2, each of the boxes that will need to be entered into TaxSlayer have been highlighted with the yellow box next to or inside the corresponding tax form box. As a reminder not to miss anything, the TaxSlayer input form will not look exactly like this, but all of the boxes on this form will be on the TaxSlayer input form. Again, just make sure to match up the boxes in the W-2 with the corresponding boxes in TaxSlayer. So what are the codes in box 12? The codes in 12 provide more information and determine if the amount is income for income tax reporting. As an example, notice that the amounts in boxes 3 and 5, Social Security and Medicare wages, don't match the wage amount in box 1. Differences between these amounts are generally explained by the information in box 12, which is A, B, C, or D. It could be multiple codes. In this case, the difference between boxes 3 and 5 and box 1 is $1,000, which matches $1,000 in box 12A. Notice the code. It's a D. Code D represents a contribution to retirement plan, which means the amount in box 12A, $1,000, is not included in taxable wages, but still subject to Social Security and Medicare taxes. And that's why the amount in box 1 is $1,000 less than the amounts in boxes 3 and 5. Code DD in box 12 tells us that the taxpayer has employer health insurance. That's for information only. Although noted in the tax return, it's not used for tax calculations. By the way, if you need to enter more than 4 codes, input another W-2 for the same employer with income of $1 in the wages, tips, and other compensation field, and add the additional codes. Make sure to subtract $1 from the wages, tips, and compensation field in the original W-2 if you have to do that. A check in box 13 retirement plan confirms the employees participating in an employer's retirement plan, as an example of 401k. Make sure not to miss the checks in box 13. If these are not checked and should have been, it could cause some calculations in the return to be incorrect. Box 14 may also contain codes. As opposed to the codes in box 12, there are no standard list of codes for box 14, although you'll see a drop-down box with some pretty common box 14 codes in TaxSlayer. Most of these codes are used by employers and states who can list any description they choose. There's one code, however, that you'll see quite a bit. That's the MAP-FML, which is the Massachusetts Paid Family and Medical Leave. You may sometimes see 2 codes in the box 14 for MAP-FML, which may appear slightly different. If so, add the 2 values together when entering the data in TaxSlayer. Be careful not to overlook this code, as the font is sometimes very small. We had to use a magnifying glass last year in order to determine what the number was on several of the returns. And if you don't find the value you're looking for in the list for a code, just use Other from the drop-down. We'll see that in just a bit in TaxSlayer. Make sure that state withholding is from Massachusetts. If you have someone who moved to our state, the taxpayer may have withholding from another state. Please remember that you can't prepare out-of-state tax returns if you haven't been trained and certified in them. Find out from your local coordinator how to handle this. And be aware that taxpayers will sometimes bring in prior year W-2s by mistake. So be careful. Make sure to verify the proper tax. Here's a list of the box 12 codes. When you have a little time, open up 4012, and you'll be able to find these codes and their meaning in tab D, along with other information related to Form W-2. If you're generating a tax return in the future and you don't recognize the box 12 code, you'll need to look it up to understand how it may impact the return. One other place to find the box 12 codes is in the back of the W-2 form. I wish you good luck in trying to read them off the W-2 because they usually are in very tiny print. Please note the codes mentioned below the list, including code D that we just saw in the W-2 example. These codes could impact a tax return, as the taxpayer may be eligible for the retirement savings contribution credit If retirement plan is checked in box 13, credits will be discussed in another presentation. On the left are some of the more common meanings for codes used in box 14. On the right are actual codes that one organization uses. It turns out the organization is UMass Lowell. Just to show you as an example what these codes could look like. So UMass Lowell is using their own codes. Note for MAPFML, they also use a code of 14Q. Again, there's no standard list of codes for box 14 on a W. Tips are considered income and are subject to federal income tax. You must include all tips in gross income, regardless of whether they were received directly, they were charged tips and paid back by the employer, or if a person shares them and splits them with other employees. The value of non-cash tips, such as tickets, passes, other items of value, is also income and subject to tax. The tips may have been reported to the employer or not reported, but all tips are subject to taxation. Tips can be reported by an employer on a W-2 in either box 7, which you see here, Social Security tips, or box 8, which is called allocated tips. The taxpayer may also have tips that were not reported to the employer. I'll discuss how those are handled in just a second. So there are two types of tips. Reported tips. On this W-2, the tip amounts in box 7 were reported by Cindy Young to her employer and are added to the total income on her return. So Social Security tax and Medicare taxes have been accounted for. And the other type of tips are non-reported tips, of which there are two levels: more than $20 in a calendar month or less than $20 per month. So again, non-reported tips are divided into two categories: more than 20 in a calendar month, less than 20 in a calendar month. Since the taxpayer doesn't report these tips to their employer, the income's not included in their total wages. So the employer was not able to withhold any tax, income, Social Security, or Medicare on that income during the year. The taxpayer will need to report this income, which will create a form. You don't need to memorize this. It'll create a form 4137. I'll actually show you what a 4137 looks like. That will ensure that Social Security and Medicare taxes for the tips are added to the return. I'll show you how to do this during our first TaxSlayer demonstration. In this example, second example for Cindy Young, she received $1,097 in allocated tips. So what's an allocated tip? Well, we all know that everyone self-reports all of the tips they receive, right? Well, the government didn't think so either. So the tax laws were changed, modified to try and capture unreported tips. So allocated tips are amounts given by the employee's company in addition to tips they report. The way the law goes, you don't need to memorize this, but if the total reported tips in a payroll period for an employer are less than 8% of the business's gross value during the payroll period, the business must allocate tips to its employees. Allocated tips are required to be paid for large food, beverage establishments where employees receive tips directly from customers. Large means the company, on average, has 10 or more employees in a typical business day. So there are a number of ways an employer can calculate how much each tip person receives in allocated tips. That's not our concern. Our concern is that the taxpayer's tip income is properly reported. It's very important to know that no income, Social Security, or Medicare taxes have been withheld on allocated tips, the same as tips that are not reported. The income reported by the employer in Box 1 does not include allocated tip amount reported in Box 8. By the way, Box 12 codes here are E for elective deferrals under a Section 403, which means some type of another retirement type plan. Employer contributions, at W is employer contributions to a health savings account. We've already seen what DD means. On the prior slide, I mentioned that there are two types of tips. There are reported tips and non-reported tips. It's really not right. There are reported tips, which are Social Security, that are taxed, and then there are the allocated tips as well. They're reported as well in box 8 on the W-2. The non-reported tips, tips exceeding or equal to $20 in a month, they are not on W-2, nor are tips under $20 in a month. So those are the types of tips. Box 7 on the W-2, box 8 on the W-2. In TaxSlayer, there's a box on the W-2 entry screen for the total number of non-reported tips. What's out of scope? One of the most important things we do is check for scope. Try always to check for scope for the entire return before you enter anything into TaxSlayer. We don't want the taxpayer sitting there for half an hour, and ourselves as well, and then discovering that something on a document at the bottom of a pile of documents is out of scope. Early in my first year as a client facilitator, I spent a lot of time helping a taxpayer organize their tax records. Just prior to passing the taxpayer on to the tax counselor, she mentioned that she was renting the second floor of her home and had been doing so for the entire year. As the rental was more than 14 days during the year, her return was out of scope, and we recommended she visit a professional tax preparer, which is what you should normally do when a return is out of scope for Tax-Aide. Always check, though, with your local coordinator before taking any action. Generally, W-2s will be in scope, but there are some exceptions. Within the Tax-Aide scope manual, you can find them, and a section, I should say. It's F for form, and then W-2. This is shown on this slide. Make sure to check the boxes for scope. In this slide, a code R is an Archer medical savings account. Code T is for adoption benefits. Q is non-taxable combat pay. It's out of scope, combat and military, unless the tax counselor, and a quality reviewer are certified for military returns. Now, what else is out of scope? Well, ministers, church workers with special tax rules, not in scope for us. Very high earned income that's subject to additional Medicare tax. Those like married filing jointly with more than $250,000 of income. Income here is Medicare wages, Railroad Tax Act compensation, and self-employment. So those added together, if they put a person above this threshold, they have to pay an additional 0.9% of tax for Medicare. That is out of scope for us. So, no W-2. What happens if the taxpayer hasn't received a W-2, but they've scheduled an appointment and want to do their taxes? Well, per the IRS, the taxpayer should attempt to get the form W-2 from their employer before contacting the IRS or doing anything else. If they don't receive missing or corrected form from their employer, the IRS specifically says the end of February, but no sooner than the 15th of February, definitely. Then they can call the IRS. There's a number to do that. It's an 800 number. They must provide their name, address, phone, and other information. They also have to provide the employer's name, address, and phone number. The IRS will contact the employer and request the missing form. They'll also send the taxpayer a Form 4852, which is a substitute for the W-2. If they don't receive the missing form in sufficient time to file their income tax return timely, on a timely basis, then they can use the Form 4852 that the IRS sent to file their return. Okay, now we're ready for our first demonstration with TaxSlayer. So I'm going to show how to input W-2. I've chosen a couple so I could show you how it works with two W-2s going in, one with taxpayer and one with spouse. In addition to that, I wanted to show you how you enter tip income. So I'll choose one of those W-2s, and even though there's no tip income on there, we'll input some tip income just to show you what happens as a result of that. But first, I'm going to pause and ask if anybody has any questions. All right, we've looked at wages and the capture of wage data. Now let's talk about interest income, which can be reported on forms 1099 INT for interest, 1099 OID, and I'll very briefly touch on Schedule K1s. Okay, income, interest, is it earned or not earned? Well, despite the fact that money you might have deposited in a bank, quote, earns interest, a taxpayer doesn't really need to do anything while it's in the bank to receive that extra money. So interest is not earned, it's unearned. Interest can be paid for cash held in checking and bank accounts, can be paid for bonds of various types, and money loaned out to others. If I loan money to my coworker Bill and he pays me back with interest, that interest should be reported by me as income. The intake interview form should indicate if the taxpayer received any interest during the year. So interest income can be reported on a 1099 INT or a 1099 OID, which stands for Original Issue Discount. You'll see those when we go into TaxSlayer. It'll be entered in the same area as interest or dividend. So interest forms might be or could be embedded along with multi-page brokerage statements. So if you see a document, you're handed that by a taxpayer that says pages like 8 and 9 of 14 or 16, and the taxpayer should be asked to provide the remaining pages, just so we're sure that we have all of the documents that we need. Schedule K1, not going to talk very much about that other than just the points on the slide. They're for estates and trusts, domestic partnerships, or S corporations. In TaxSlayer, if you ever receive one, it'll ask you which of these you have so that it can generate the proper form. Beyond that discussion, I don't know that I've seen a K1 before. So we'll end the discussion with that. So interest income may not be reported on a nice clean form like a 1099 INT. If I have a home trying to sell it, Jane Doe wants to buy it, but Jane Doe can't acquire a mortgage. I could offer to, in effect, set up a mortgage for her and have her pay me interest. In that case, I'm probably not getting a 1099 INT from Jane Doe, but I'm still collecting the interest, and I need to report that as income. Private and foreign payers is another situation. The other one is interest rates less than $10. Banks and so forth, they won't send you a statement. You may have received $6 in interest on a checking account. That is still, even though you didn't receive a statement, a form, that $6 is still income, and you should include that, or the taxpayer should include that in their total income. It's got to be entered in the return. Even tax-exempt interest that's not, it's tax-exempt, that needs to be reported as well, even though there's no tax on it. So all interest is taxable except we just mentioned state municipal, including DC and US possessions. Some may be taxable to the state of residence. US obligations, T-bills, savings bonds, they're taxable on the federal return. The exceptions are EERI bonds used for education expenses, but those are out of scope for us. The US obligations are exempt on our state returns. That'll be covered during the discussions of state of Massachusetts tax. I'm showing this just to focus on the column under taxed US. It shows whether bank and bond interest is taxable or tax exempt. In the taxed US column shows whether the interest is taxed by the federal government. Later during the mass training, you'll learn how bank and bond interest are taxed, partially taxed, or not taxed at all by the state of Massachusetts. Here you'll see that the bank interest in government bond is taxed by the federal government, and municipal bonds, no matter what state, are not. There are early withdrawal penalties, and you'll see the early withdrawal penalty, we'll see that in just a moment, on the 1099 INT. If someone has a CD and they cash out that CD before maturity, then there could be a penalty assessed. Penalty is subtracted from the adjusted gross income. It's an adjustment to income, and it's located in box 2 of the Form 1099 INT or box 3 of the OID. Here's an example of a Form 1099 INT. Tom Andrews received interest of $550 from a bank outside Massachusetts. He received a $55 early withdrawal penalty. One thing I don't think I've ever seen is that FATCA box checked. That is out of scope if it's checked. That stands for the Foreign Account Tax Compliance Act. Don't memorize it. Just know that if that box is checked, it's out of scope for us. I just want to say that I've not worked on a taxpayer return that involved a 1099 OID, but I did want to explain how an original issue discount works. Normally you buy a bond, and once you purchase a bond, the bond's issuer would usually pay you an interest rate. That's called a coupon, well, while you hold the bond. Every so often you receive interest payments based on the rate of the bond. So when the bond matures, reaches maturity, which is a specific day or date when the bond needs to be paid back, it's paid back at its face value. And what you've received then is the face value of the bond plus the interest while you held the bond. Some bonds are different. An OID is a bond that's sold for a price that's less than the face value, if you will. And the interest you receive, or the taxpayer would receive, is the difference between the face value and what they paid for it. So if I had a bond, an OID that was $100, and that's what I would receive at maturity date for it, and I only paid $95 for it, then the $5 difference at the end is the return on my investment. And basically that's my interest. So as opposed to a traditional bond where you have interest accruing while you hold it and then the face value paid out, at maturity with an OID, you realize your return, that $5 in this case, on the day it matures, and they pay you money. So that's the bottom line. We won't talk about it much. I just wanted to mention it, and just to let you know, it's a different type. And again, at the end, there'll just be a interest at the maturity date. An OID is reported as regular interest. Boxes 5 and 10 on the OID form are in scope. It's out of scope if it requires an adjustment, an entry in box 6 for an acquisition premium. There's the chart from the scope document at the bottom of the slide showing what's not in scope. The only other thing I want to do is show you a copy of the OID form. Here is the OID form. Note the FATCA, out of scope, and the acquisition premium at box 6, out of scope. That's enough for now on an OID form. So I'll demonstrate how to enter a 1099 INT into TaxSlayer in just a bit. We'll do that when we finish with the 1099 DIV for dividends. But before moving on, I just wanted to stop here and see if there are any questions or comments at this point in time. Okay, next on the agenda is dividend income. So, dividends. A dividend's a distribution of corporate earnings, it's from a corporation's earnings to eligible shareholders. They can be paid out directly. I can receive if I own shares in, let's say, Apple, or potentially I could reinvest them to buy additional stock, like Apple stock. Dividends are reported on a 1099 DIV or Schedule K1. They could be embedded in a brokerage statement. And we'll see a couple of examples of a 1099 DIV in just a couple of minutes. Dividends are paid out of earnings and profits from corporations. The dividends are paid to equity shareholders. We just talked about that. They could either be received in a direct payment or could be potentially reinvested to buy more shares of whatever the holding is. Now, dividends include ordinary dividends. Some people call them non-qualified, unqualified. Those are taxed as ordinary income, meaning an investor would pay federal taxes on the income at the individual's regular rate. If I were in a 20% tax bracket, the top end, any dividends on top of that would be taxed at least 20%. Qualified dividends, on the other hand, they're taxed at capital gains rate. And recipients of those dividends might owe 15%, might owe 20%. They may owe 0% tax on those dividends. A qualified dividend normally would be held for a specific period of time, like 60 days, 90 days, 120 days, in order to be classified as a qualified dividend. So from a tax perspective, the difference between what people call ordinary dividends and qualified dividends is the way that they're treated tax-wise. Now, Section 199A dividends, real estate investment trusts or REITs, those are dividends paid out by REITs or funds holding REITs. And REITs are companies that hold, thinking of specific types of things here, they hold, they own, they operate income-producing properties, apartment buildings, cell towers, medical facilities, offices, warehouses. So that's what a 1099A dividend would be. But before we move on to the next slide, I want to emphasize that dividends are taken out of earnings and profits. Next, we're going to look at another type of payment to tax holders that are funded differently. And I said mutual funds, exchange-traded funds, and REITs we just talked about pay capital gain distributions. While a dividend is income from earnings and profits, a capital gain distribution occurs when the fund sells assets during the year and then gains on those sales exceed any losses. So capital gain distribution is a payment, let's say by a mutual fund, of a portion of the proceeds from the sales of stocks, like during the year. They're buying and selling stocks. Any proceeds then are distributed out to the shareholders. A Section 1250 gain, Box 2B, on the DIV form is taxing of gains from the sale of depreciable property. So things like commercial buildings, warehouses, rental properties. And that will show up again in Box 2B. We've been talking a lot about out of scope. So for a 1099 DIV, a reporting of dividend income, here are items that are out of scope. Box 2C, 2D, 2E, 2F, and boxes 9 and 10. Here's a 1099 DIV form. Note the boxes are out of scope, as well as the Foreign Account Tax Compliance Act box, which, if checked, is out of scope. I just want to mention one small item. You don't have to remember this right now, but box 5. Box 5, if there's an amount in box 1A for ordinary dividends, box 5 would show the portion of the amount in box 1A, that is, that may be eligible for what's called a qualified 20% of the qualified business income deduction. What that is, the qualified business income deduction, is a tax deduction that allows eligible self-employed and small business owners, who we're going to learn about this afternoon, to deduct up to 20% of their qualified business income on their taxes. And I bring it up because we will be talking about self-employed people this afternoon. Here's an alternate form of a 1099 DIV. I believe there's one in the study guide that's very similar to this. And basically, it's the same boxes. They're just laid out kind of vertically here, if you will, in rows versus having boxes. No difference in what the boxes are. So I'll admit that this is old, but this is what a kind of typical brokerage statement might look like at the end of the year, reporting yearly dividends and interest and so forth, combining it all into one statement. You can see there's a 1099 DIV, there's a 1099 INT, there's a 1099 MISC, and there's a 1099B, which is a brokerage statement, all on one, combined on one form, if you will. There are 4 different forms, all on one page. I want to talk just a little bit about reinvested dividends. Reinvested dividends are taxable. I mentioned Apple a little while ago and said Apple might pay out a dividend, and with that dividend, a person could, instead of receiving the money directly, reinvest it to buy more Apple stock. So when a dividend's paid out, if it was $500, the taxpayer receives the $500. Well, it's paid to the person, but they chose to purchase $500 worth of new shares. They got to report that $500 as income. I'm talking about this because I met with a taxpayer last year who tried to convince me that there was no tax on dividends that were issued to the taxpayer because the taxpayer never received anything when they were paid out. You could see on the brokerage statement where clearly the dividends were listed and then were reinvested, used to purchase additional shares of the stock. So I'm just saying this to be prepared for taxpayers who might make claims like this, and be ready to show them, here's where you received the money, and here's what happened with that money, but you still owe tax on that money. In the next demonstration, I'm going to show how to enter a 1099 INT and a 1099 DIV into TaxSlayer. These may look familiar to you because I've copied them straight out of the study guide. So here's the 1099 INT. And here's the 1099 DIV, which will enter into TaxSlayer. But first, please let me know if you have any comments or questions about what we've covered so far. Okay, next we're going to talk about state income tax refunds. It's reported on a Form 1099-G. Now, taxpayers receiving refunds from the state may be required to pay federal tax on all, part, or none of the refund they receive. In some cases, the taxpayer will provide the refund form. In others, they may not have it. Major factor in deciding whether the taxpayer owes any money on state income tax refund is whether the taxpayer chose the standard deduction or chose to itemize deductions during the tax year the refund is issued for. Bear in mind with me for just a minute. I want to ensure that everyone is familiar with the term standard deduction and itemized deductions. The IRS defines the standard deduction as a specific dollar amount that reduces the amount of income on which someone's taxed. The government just assumes that any state taxes a taxpayer might have paid, plus gifts to charity, and other items they might have otherwise been able to deduct from their taxes, fits within the standard amount. If I file as a single taxpayer and my total income is $100,000 and the standard deduction is $15,000 for a single taxpayer, my starting taxable income would be $85,000, which is $100,000 minus $15,000 before any taxes are applied. So a taxpayer's standard deduction consists of the sum of the basic standard deduction and any additional standard deduction amounts for age and blindness. On the slide, left column, standard deduction for 2022. Single person or single filer, $12,950. Married filing jointly, $25,900, and so on. Additional amounts are added for age, if you're over 65 or older, and for blindness. A taxpayer's itemized deduction consists of the total amount of the items listed under itemized deductions on the right-hand side of the slide. If a taxpayer's standard deduction is more than the total of their itemized deductions, then choosing the standard deduction would normally be the taxpayer's best choice. So taxpayers are free to decide. They can decide they want to use standard deduction or use their itemized deduction. There's a box in TaxSlayer where you can say, I want to itemize, I want to itemize. It should be noted that the last major tax changes doubled the standard deduction. Since that time, it's best for the vast majority of people, probably 90 or higher percent of taxpayers in general claim the standard deduction versus the itemized deduction. So where do you look to see if a taxpayer received a state refund, state tax refund? Well, in the intake booklet, they should have noted if they received a Form 1099-G. If they didn't receive 1099-G or don't remember receiving one, then the best place to look would be in the prior year's income tax return. And in there, you would see that they had a state refund. So this is what a Form 1099-G would look like. In the case of a state tax refund, that the number would go into box 2. So is a state tax refund taxable? Depends on something called the benefit. What that says is if the taxpayer itemized and received a state refund, it's only taxable if the taxpayer got the benefit of the deduction. And this can be determined by filling out the state and local refund worksheet that we'll have in the demo actually later in TaxSlayer. The bottom line here is if you choose to itemize using state and local income taxes, your state refund is taxable. However, It's only taxable to the extent that it's more than the refund you would have received by choosing the larger refund from the standard deduction of general sales tax. Sorry to confuse it. I'll try to use an example. If I received a refund of $300, I itemized, and I received a refund of $300, and that was only $100 more than I would have received if I chose the standard deduction or the general sales tax, whichever was larger, then I should at maximum only have 100 of that refund subject to tax, right? I could have gone one way and only been taxed on $100. Why should I be taxed on more than $100 then? So it's confusing, but we don't have to worry about the details, fortunately. Again, there are tools we can use. One of them is that local refund worksheet, state local refund worksheet. It's in TaxSlayer. And the other one is Bogart's refund and recovery calculator. And that's a tool that Jeff Bogart, among other tools, that he's developed and maintains. And we'll show you how to access the tool, but we'll use the local refund worksheet in TaxSlayer in one of our demos. So if the taxpayer received a state refund last year, does it count as income in the current year? The answer, again, it depends. If the taxpayer used the standard deduction last year, assuming it was the refund is for last year, the answer is no. Anyone who used the standard deduction owes no tax on the state refund. If the taxpayer did not receive a Form 1099-G, it depends. The counselors, that's us, would use the worksheet in TaxSlayer or Bogart's refund and recovery calculator I just mentioned to determine the taxable portion of the state tax refund. Again, example to follow. What about taxpayer itemized? Well, if they use the sales tax deduction instead of using the income tax deduction when they itemized, the answer is no for those who chose the sales tax deduction, no tax. If they use the income tax deduction, it's another maybe. And again, that's where we would use the tools that do the calculations, perform the calculations for us to determine if any of it is taxable. So just to summarize the tools, there is the option of using the TaxSlayer state and local refund worksheet, which you can find a picture of, if you will, in publication 4012 tab D. There's a direct link to the Bogart refund and recovery calculator. And we'll, again, have that demonstration soon. Here's the view in Pub 4012 showing what the refund worksheet looks like in TaxSlayer. And all we need to do then is to fill out those boxes with the proper information and allow the worksheet to run the calculations for us. You should be familiar with, if you want now, very soon, you should be familiar with the Massachusetts Tax-Aide site on the web. The address is up in the left corner, mataxaide.org. You go to that address, and on the page to the right are a number of sections within one are Bogart's tools. At the very bottom is the taxability of state refund calculator. You go there and here's what the tool looks like. Make sure if you do use this in the future to put in the proper tax year, make sure the proper filing status is noted in here. The first time I used it, I had the wrong filing status and was way off in terms of calculations, at least what I thought they should have been. So caution in terms of first filling in those fields with the correct information. All right, I'm going to pause here to ask if there are any questions or comments at this point in time. Alimony income. Alimony rules. It's important to note that the tax rules concerning alimony changed effective January 1st, 2019, so right after December 31st, 2018. Prior to the changes in, I believe it was the Tax Cuts and Jobs Act, alimony payments were tax deductible by the person making the payment, and the person receiving the payment, the alimony, had to claim it as income on their federal tax return. So after January 1st, 2019, alimony is no longer tax deductible to the payer and no longer reported as income to the receiver. Now, if divorce papers or decrees in effect prior to the change in the rules, prior to January 1st, 2019, are modified by a court order to explicitly spell out that the repeal applies, then payments under the divorce agreement, the new divorce agreement, would be taxed according to the new rules. So if they modify an agreement that was set in place before January 1st, 2019, and it states that the new rules apply, then the new rules apply. If there's no modification, the alimony payments entered into prior to January 1st, 2019 are still deductible by the payer and taxable income to the recipient. I think that the original date is back in 1984, so it was from 84 to the end of 2018 when these same rules applied. Again, alimony under pre-2019 orders, it's grandfathered, so alimony received continues to be taxable. It's compensation for IRA purposes. So if someone receives alimony, they can use that to help to make contributions to their IRA. And alimony payments continue to be deductible. So verify information related to alimony in the intake booklet. I should mention it there. Look at the prior year return. Was there any alimony income? Confirm that it is required by a divorce decree or a separation instrument, and the payment is not child support. The taxpayer needs to provide current information on the actual amount received in the current year. So, for example, $500 a month or a yearly total. I believe in the study guide exercise we have, it's a yearly total that was provided. I emphasized earlier on in the presentation this morning that there's reasons for knowing income is earned or unearned. So alimony received is not earned income for the earned income credit. It's not earned income for the child tax credit. It's not earned income for the dependent care credit, but it is compensation for IRA contributions. Again, that's when grandfathered pre-2019 rules apply. So it can be used to make contributions to IRAs. So taxpayers paying alimony typically are aware of the tax benefit. Verify that the amount deducted is only the alimony portion. Again, no child support. The total amount paid is entered in deductions, adjustments, alimony paid. Taxpayer will require the date the divorce or legal separation took effect. That should be reported, that should be noted on the intake and interview sheet. So next there'll be a demonstration of entering alimony into TaxSlayer and entering a state refund, a 1099-G, and using the worksheet to determine whether tax is owed on the state refund or not. Before beginning the demo, however, I'd like to ask if there are any questions or any comments at this point. So before breaking for lunch, I wanted to share something with the group that has helped me greatly, and especially for new tax counselors just starting out. I would sit there trying to determine where a specific form, where I would go to input the data for a specific form. And after a while, I decided I needed to do something better. I couldn't remember it all. So I sat down one night and I pulled together, I said, okay, alimony. Alimony, you go to deductions, you go to adjustments, you go to alimony. Educator expenses, student loan interest. I walked through all of the types of forms and tasks that I needed to work on and came up with this quick step guide. This is my own personal quick step guide saying if you've got rental income, you go to income, 1099 MSE, rents, and so forth. And this has helped me greatly. I use this form still. I have a copy of it and put it on the desk next to me every day when I start working on tax returns. So I have one for the federal side, and then you'll see the state in just a second. So here's the equivalent for federal, which I just showed you for Massachusetts. I won't go into it because won't be working on Massachusetts for a while, but I did the same thing. So if I wanted to look up where savings bonds go, where do you report savings bonds in Massachusetts? Well, income subject to tax, Schedule B, interest dividends, not taxable in Massachusetts, and you've got it. Saves a lot of time. Last year, earned income credit, if taxpayers earned income, was higher in 2019 than 21. These are just things that I wrote down. Anything that was really common that I would need to do, or just to remind myself to check on that, to make sure I checked on that. So anyway, I just want to throw this out there. If you're not as slow as I am, you may not need this, but I certainly do. Anyway, that's it. Let's break for lunch.